Welcome to today's explainer. Look, if you've been checking your portfolio lately, you're probably feeling the panic, right? We are witnessing some extreme market volatility right now, and it is absolutely wiping out tech and AI investors left and right. But we have to ask, is this a fundamental market crash, or is it something else entirely? Let's get right into it. I'm Chia Chen, and welcome to the Chia Chen Research Lab. Today, I'm putting on my professional investment advisor hat. We are going to cut straight through all that emotional noise and those screaming headlines you're seeing. Instead, we're going to rely entirely on hard, data-driven analysis to figure out exactly what is happening under the hood of the markets right now. So I want to start by posing the big question, the one that is literally on everyone's mind. Are we witnessing the end of the AI revolution? Is the bubble finally bursting? Or are we just watching the brutal mechanical slaughter of over-leveraged retail investors? It's a terrifying moment for sure, but we absolutely need to separate fear from facts. Let's dive right into the reality of these drops, because honestly, the numbers are terrifying. The recent sell-offs have been nothing short of brutal. I mean, we saw Micron drop 13% in a single day. Giants like Samsung and SK Hynix plunged over 12%. And SpaceX? They erased $800 billion in market cap with a 16% loss. To the average investor, this looks exactly like a bursting bubble. But let's dig a little deeper. Before we can truly analyze the sell-off, we've got to understand why retail investors are taking on so much crazy risk in the first place. Take a look at this massive wealth concentration in the US. The top 1% of wealth holders own nearly 50% of the entire stock market, but only about 13% of housing. Younger generations see this. They realize the old American dream of just buying a house isn't the primary vehicle for extreme wealth anymore. The stock market is. And this dynamic creates a massive structural trap. Over the last 40 years, U.S. productivity skyrocketed by 300%. But median wages? They only grew by 150%. Wealth has totally decoupled from the working class. This creates immense financial pressure and really intense FOMO, the fear of missing out. People are feeling stuck, so they turn to these highly leveraged ETFs just to try and catch up. We are actually seeing this exact FOMO phenomenon playing out in real time over in Taiwan right now. Trading accounts there recently surged from 4.66 million to 5.79 million in just a matter of months. Margin balances are hitting all-time highs. Retail investors are blindly rushing in, chasing AI prospects, chasing dividends, and buying on heavy margin. With projections saying Taiwanese millionaires will grow by 47% by 2028, these retail investors are terrified of missing the wealth train, so they are piling into debt just to get a ticket. But here is where it gets incredibly dangerous. 38.5 trillion Korean won. That translates to roughly 25 billion US dollars. That is the current record-breaking margin debt balance in the South Korean stock market. Think about that for a second. This isn't just invested cash. This is borrowed money. This is pure, unadulterated leverage. Which brings us right into the leverage death spiral. It's a mechanical nightmare. When an overextended market naturally corrects, holding a 2x or 3x leveraged ETF turns a totally normal 12% drop into a massive 25 to 37% wipeout. And what happens next? Mass margin calls. Brokers demand cash to cover the losses, these retail investors don't have it, and that leads to forced liquidations. They are literally forced to sell at the exact bottom, which creates a chain reaction of panic selling. This is math doing its thing, not fundamentals failing. So, because of all this, we are looking at two completely different realities right now. The retail noise is out there screaming that the AI bubble is bursting, demand is dead, and we have overcapacity. But the institutional reality? It's completely different. Smart money sees this simply as a healthy, necessary cleansing of weak hands and those over-leveraged retail positions. The core fundamentals haven't broken. Don't believe me? Let's look at what the hedge funds are actually doing. Right now, hedge funds hold short positions, meaning bets against the market, at a volume 2.4 times higher than their long positions in indices and ETFs. They are actively and deliberately putting pressure on the market to squeeze out all that leveraged retail money we just talked about. It's intentional. Meanwhile, let's zoom out and look at the ultimate fundamental anchor, $100 billion. That is the rough annual run rate of AI capital expenditure from the massive cloud giants. We're talking Microsoft, Amazon, Google, and Meta. Despite all the wild market panic lately, not a single one of these companies has indicated they are slowing down their AI infrastructure spending. The core engine of the AI trend is still roaring.
And taking it a step further, look at TSMC. They are the foundry actually building the chips for all of this. TSMC is currently planning to raise prices on its 3nm and 7nm advanced nodes by roughly 5%. This move alone is going to boost their gross margin by over 2%. Listen, you do not successfully raise prices like that in an environment where demand is dying. This proves that the underlying long-term secular AI trend remains incredibly healthy.
To put things into perspective, just look at these year-to-date growth numbers for 2026. DRAM spot prices are up 273%, and HBM4 memory is up an insane 435%. When assets surge this astronomically, a 10% or 20% pullback isn't a crash. It's just normal, healthy profit-taking. You simply can't look at a 12% daily drop without acknowledging the massive 300% run-up that happened right before it. Now, as professional investors, we obviously shouldn't ignore risks entirely. We just need to make sure we are focusing on the real risks, not the retail panic. And the real paradigm shift happening right now is the US-China AI price war. The competition is no longer just about who has the absolute smartest AI model. It is rapidly becoming about who has the highest cost performance value, or what we call CP value. Here is what that actual threat looks like. Check out China's open source model, Zhipu AI's GLM 5.2. Back in 2023, top US models had this massive 60% performance lead. Today, that gap has narrowed to under 10%. But here's the real kicker. The Chinese model costs roughly 1/10 the price to deploy. If enterprises can get 90% of the performance for literally 10% of the cost, that severely threatens the massive return on investment strategies of the US cloud giants. That is a real fundamental metric we need to be watching. Switching gears slightly, we also have to stay hyper-aware of basic supply and demand mechanics, which is exactly what triggered the recent SpaceX stock plunge. Driven by pure retail hype, SpaceX actually briefly surpassed Microsoft in valuation. But here's the reality. Only 5% of their shares were actually liquid on the market, which created this huge artificial price spike. With insider lockups expiring after their August earnings, that circulating supply could jump 9 to 10 times by September. When a massive flood of new stock hits a market where retail buying has dried up, prices collapse. Again, mechanics over fundamentals. So what does this all mean for us? Where does it leave us? Well, high interest rate expectations are absolutely crushing the overvalued, speculative small and mid-cap stocks. But for the core pillars of the AI revolution, valuations are actually compressing down to really attractive levels during this washout. Take Amazon as a perfect example. 3 years ago, its price-to-earnings ratio was a staggering 146x. Today, after market corrections and solid earnings growth, it has dropped all the way down to just 28x. The market is naturally, albeit violently, finding its real value point. I like to explain this using what we call the sleeping in the park cycle. It's a bit of a joke among retail investors that when the market crashes, you'll have to go sleep in the park. But look at the timeline. In the 2018 bear market, we slept in a basic local park. In the 2020 pandemic crash, the market bottom was actually higher, so we upgraded to a nicer park. In 2022's inflation crash, an even better park. And in this current 2026 correction, the bottom is so high compared to historical levels, we're basically sleeping in a luxury hotel's private park. The core characteristic of a long-term bull market is that it continuously establishes higher and higher lows. And that brings me to my absolute most important piece of advice for you today from an investment analyst perspective. Be right on the trend, but don't die on the volatility. The secular AI trend is undeniably real, guys, but if you use massive leverage to try and get rich quick, you will be mechanically wiped out by standard market volatility way before that trend ever matures. Maintain your psychological resilience, ditch the dangerous leverage, and hold firmly onto high-quality spot assets. The market is cleaning house right now. Just make sure you aren't the one being swept out. Thanks so much for joining me today, and I'll catch you next time.